Okay, welcome to the Aramir Roundtable. Today is the 25th of July, 2022. And we have Luc Van Hof with us, will update us with the Enigma Trade System. So welcome, Luc. I hope the system's doing well with these kind of choppy markets.
Hi, good afternoon, Tom. Yes, I am happy to give some more information about the system as it is currently being performing and how we are handling this market environment.
Excellent. And you should be able to share your screen.
Okay, perfect. So.
And I see your desktop.
Okay. And you see the PowerPoint?
I do.
Okay, perfect. Okay, that's fine. So what we'll try to discuss today is obviously, because there are some new people in the group, to give an overview of the system itself, about how does Enigma work, what is it consisting of, and then of course Q&A as usual. So I'll start with a quick disclaimer, which is the standard one. Aramir Corporation is not a broker-dealer or investment advisor. It's strictly for educational purposes. Options, futures, and bonds, of course, anchor assets involve risks, not suitable for everyone. Past performance not necessarily indicative of future results, and it's for personal use only. So with that out of the way, let's continue. So a quick overview of the investment philosophy and the trading strategy. Of course, people who are not new to this will probably find this a bit repetitive, but we'll skip some of the steps. But in order to provide everyone with the necessary background, I'll cover the main points, of course. Then about the trading engines, the trade sizing, a couple of examples for the current market environment and for the bullish and bearish in general, and then risk management and performance. Okay. So my investment philosophy is actually pretty simple. It's trying to manage ignorance. With that, I basically mean you have to be aware of how much you actually don't know. So all of what we do, our trading is exclusively based on research, tested strategies, methods of approaching the market. So as we don't know what will happen next, of course, it's very important to be prepared for some nasty surprises that the market could present us. So we have to be very risk averse, in my opinion, of course. And that's why the Enigma system is built around that concept. As a general outline, of course, we need to mention that we are considering the market being not perfectly efficient at all times. If not, it wouldn't make any sense to try and trade. But of course, on the short-term basis, on a short-term horizon, there are plenty of imperfections that we try to capture. And these can be either risk premia or inefficiencies. And the inefficiencies are so-called market caused or market derived inefficiencies, something that is not necessarily being noticed by everyone, while the risk premia is really a compensation for taking a risk. And it's these two types of anomalies that are the basis of the short-term trading strategies that we've created. So in a nutshell, we trade only and exclusively the S&P 500 futures, either on the E-mini or on the micro. We use three groups of algos to determine what direction we should trade in, and also, of course, what trade size we should use, which, as you will hear in a couple of minutes, is the key issue about Enigma trading. It's about the convexity. And these three different trading styles, they are all without any parameter optimization. So they have not been curve fitted or optimized to represent a certain market condition. It's really very general. So they are in essence very simple. And I think that's the power of the strategy, that it is something which is which generalizes very well. That's actually the correctly scientific term. So it can work well in different types of markets. In other words, we don't really need a specific market environment for the strategy to perform well. It should handle most situations. And why is that? Because we use these three different groups of algos, and they are actually different, of course. If not, it wouldn't make any sense, but they can neutralize each other's weaknesses. And that's why after a certain period of trading, they usually come out ahead in even in the most challenging market environments. In terms of time frames, we trade multiple time frames, but we only execute the trades within the day session. So we don't use any overnight positioning in terms of trying to get out or into a trade outside the regular trading hours. We will, of course, hold positions overnight, but we won't intervene outside the day session. And in terms of trading frequency, it's actually a low trading frequency strategy. So the average is about 3 trades per week, although we can have sometimes 5 trades in a day and sometimes only 1 trade in a week. So it is quite a variance in terms of the trade frequency, but on average, it's about 3 trades per week. So the normal steps that we try to employ in terms of trying to create a trading strategy is going from research to the strategy in 4 different phases. First, trying to detect a market anomaly or an inefficiency, as it is called as well. Then do the statistical testing. In other words, trying to prove scientifically that indeed there is some convincing reason for the anomaly that we think we might have found to exist. And once it passes that second phase, we have to try and build an algo that will run through the tick-by-tick database, because we use a tick-by-tick database, not an hourly or daily database, to account for potential stop-outs or profit targets that could be reached intraday. And the algorithm then, of course, tries to find what is the ideal way to monetize the edge that we think that we have discovered. Now, in general, these first 3 steps are relatively easy to do. It's actually the 4th one, the last one, which is the tough one. And that's to make the algorithm and build it in such a way that the trade becomes scalable. So the sizing of the positions, and of course, also to verify if the trade can be, or the trading strategy, I should say, can be traded on a larger scale, is what makes it really very challenging. But so far, we have accomplished this using a combination of 3 different algos, 3 different, what I call trading engines. We have one which is most people are familiar with, which is the momentum driven or the momentum algo. It's pretty straightforward. It tries to find or detect any directional movement which is significant, either to the upside or to the downside. That's the positive or negative directional movement. The second one, the bias one, is slightly more complex because it uses a classifying algorithm, in that sense that first it will classify all market movement into either an upward or a downward class. And of course, then it has to pass a certain threshold so that we know that the downward movement or the upward movement is significant, is strong enough to potentially generate a trade. And once that's reached, so assume that the market reaches a situation where it goes beyond the upper threshold, then we have to wait for some confirmation within a certain time frame, which has to confirm the strong upward move. So in other words, it's not like a one event thing. It has to be confirmed after it has already been classified as significantly strong or significantly weak. So that's why it's a bit more complex, and usually it doesn't trade very often, but during other periods, like recently, for example, it has been more active. It's also the more flexible one of the 3 trading engines. The third engine, the third algo, is what we call the hedging algo, and it detects short-term extreme prices. So in other words, it is trying to find if we are near a short-term tail risk event. And that's why it's then classifying it as well as either up or down. And the specific or the very peculiar thing about this third algo is that it's never going to be flat. It's always going to be in the market, either to the upside or to the downside. So it's in essence a reversal trading strategy. While the two others can be long and then go flat and remain flat for a while and then maybe go long again or go to a short position from flat and so on. But the hedging doesn't do that. It will always be in the market. Now, in terms of the trade size, that's where it becomes really interesting. Then you can see on that on this table here how flexible the strategy can be. It can go from a very extreme short position, which can be as big as -6, to a very extreme positive position, a long position of +6. Now, most of the time, it's going to be around 0 or 2. Of course, one may wonder, how can we make money if the position is 0? Of course, that's the result of these 3 building blocks, the 3 strategies, having built positions over time. So imagine that we are flat when we start the day, we have no position. And then we have a long position that is being created by, for example, the momentum algo, so the first one. So we buy, for example, 2 contracts. So then we are long 2 contracts, of course. If this happens, say, in the first hour, it could be, for example, at 39.50. And if the market then does nothing but go up, the momentum algo is probably going to stay in the trade because it's bullish, it's long, there is no reason to exit the trade. If at the end of the day, this move is really becoming explosive or maybe exaggerated, then the hedging algo will probably detect some short-term risk, in other words, some excessive movement, and might generate a short trade. So the result of that is that we bought 2 contracts using the long momentum signal, and now actually we're going to short 2 contracts from the hedge algo. The net result then, of course, that we are flat, but what we have actually done is we have locked in a certain profit. Now that profit is now locked in and doesn't change until, of course, one of the 2, either the momentum or the hedge, is going to exit the trade. And imagine that the market then comes back down and the momentum is exiting the trade, then we suddenly transform our position from a flat position to a -2 because the hedge is still short. And so that's, well, how we basically adjust the trade size on a regular basis. And that happens, of course, only during the day session. And each of the 3 algos can generate these signals and help build or make the positions larger or smaller as a function of how the market is behaving and how the system is adjusting to the market movement. But so important to remember is that this short exposure can really become extreme. It doesn't happen very often. As you can see, the frequency of that happening is like 2-3%, that we are at -5 or -6, that we can go as deeply negative, I should say, as -3 happens slightly more often. So here we have this -3 at 1.5, but of course we have to add this as well. So we could be seeing something like a 12% possibility to see at least a negative position, but not exceeding 3 negative. A flat position we have about a quarter of the time. And then to the upside, we see that having a position of +2 is 28% of the time. And the more extreme we go, of course, the less often it happens, with the exception of this one, because the extreme +6 happens more often than, for example, a +3 or a +4 or a +5. And the reason for that is that when these kind of extreme scenarios happen on the long side, the hedging might be reversing from short to long and actually then adding to the momentum or the bias. So in a nutshell, we can see a lot of variation in terms of the net position of the system, because it's the combined, the aggregate total, I should say, of the 3 underlying algos. But what is important to remember is that the average position is not really big. It's like the same as the S&P. It's like buying the market. So you would be long 1 contract on average. But of course, that 1 position, the 1.06, which is the historical average, is not going to happen very often, about 6.6% of the time, but we will be fluctuating positions and changing positions quite a lot. Like, for example, today, we started the day with a position of +1, and then actually exited one trade, which was the momentum trade. So we went in from +1, we sold 2, so the long 2 from the momentum were exited. We arrived at a -1, then actually we had an additional exit from the bias, and now we're at -2 because we're still short the hedge from before. So this variation in position is what really drives the performance. Here I have an example, and of course, what is also important to mention is that although Enigma consists of 3 building blocks, momentum, bias, and hedge, the relative weight of each of the 3 can vary over time. For example, we could have a situation where there is no position in bias, no position in hedge, and only momentum is active, and vice versa. A standard position would be more like this, where we have potential for 2, 2, and 2, which is what we are trading now. But this 2, 2, and 2 could result, of course, in a -6 on the extreme short side or a +6 on the extreme positive side. But within that distribution, we could occasionally see additional add-ons, as we call them, to the bias and the hedge. While the momentum is the more static version, or this more static algo of the 3, I should say, the hedge and the bias are more flexible. But the constraint that is always overruling the total position size is we can never exceed the +6 or the -6. So we could imagine a situation where the momentum, for example, is not generating any trading signal, and that will happen when the market environment is extremely choppy. And we actually ran into such a situation at the beginning of June, end of May, beginning of June, when we got chopped up with momentum trades. And after a while, then the system automatically will scale down the trade size, so actually filter out any potential new trading signals that the momentum algo could have generated. So then we are stuck with only, say, the bias and the hedge. Now, of course, then we can't theoretically reach the +6 or the -6 level, but what then can occur is that we will add more weight. In other words, instead of trading just 2 legs, we could have 2 or 3 on the bias side or on the hedge side. So we could still reach a bigger position than the simple +2 and +2. So it will be compensating the fact that one of them is being put, say, on ice temporarily. And that can happen with either of the 3 algos. Here I have a couple of examples which were kind of extreme. For example, here in November 2020, we had an extremely strong market on the S&P. And you see in red the position that Enigma took. So it went to the maximum long position +6, then actually went back to only +2, while the market was still positive, of course, but you can see that the strength of the move was more or less over. So it started off extremely strongly, but after about 10 days in the month of November 2020, it basically went more or less sideways. The market was still strong at the end of the month because it ended up with like a 10.75% return, while Enigma did some long positioning, extreme long positioning at the first week, maybe even slightly longer, but then build it down gradually to +2, then rebuild it, and then actually went to only a +2 position. Now, of course, then you can ask the question, how is it possible that it can make the same kind of return as the market while it's actually scaling down the long positions? It's because of the fact that when we are at +6, we're of course like at 6 times leverage compared to the market. Remember that the average position is +1, which would be like the equivalent of the S&P or the E-mini or the micro. And when we build, of course, a position which is 6 times bigger, even temporarily for a day or 2, or here in this case, because it was an extremely bullish environment for like a week or even longer, but then it's very quick at reducing the open position. And so in that extremely bullish month, we ended up with about the same return as the market, net after fees, but it's actually quite exceptional, as we will see on the latest slide, that when the market is extremely strong, that Enigma is usually not capable of tracking it perfectly. It will probably capture something like 30–40% of an extremely bullish month. And vice versa, when the market is extremely negative, Enigma is usually not losing money, but it's actually making money. And we will also see examples of that. I think this is actually a good example in January of this year, when the market was actually starting from the all-time high on January 4th, and then started to come down steadily, actually returning more than 5% down for the month. Enigma went from a slightly bullish position, which it had established in the first days of the new year, then gradually built it down to -4, back to flat, to -4, back to flat, -4, then actually bullish on probably January 26 or 27 here, when the market seemed to be starting to recover. And so doing this, it made over 3%, while the market in the same period, over the same period, actually lost 5%. So these kind of exceptional things can happen when a very bullish market is taking place. It's not necessarily the case that we will be able to track it perfectly. In the majority of cases, we will only be tracking some or capturing something like 30–40% of the up move. While if the market is more to the downside, it's much better. And that has to do, in fact, with the simple reason for that is that the hedging is usually going to go short quite quickly at the beginning of the start of the down move. The momentum might be positioned wrong, but will exit relatively quickly, and the buyers will probably not fire any signal. As a net result, we will have a net position which is short, and that could be actually added to when the momentum turns clearly into the negative bias. Now, of course, not every month is going to be good. And here we have an example of the market doing next to nothing, and we actually having a very bad month. Like in this month of May 2021, you see that the market actually was up slightly, about 55 basis points, went up as much as 1.23, down as much as 2.83. So the blue line, you see what it does. Nothing spectacular, but more or less flat from the start to the end of the month. Enigma had a very tough time because it went short when the market was coming down, went long, went flat, went long, went flat, and all in all got chopped up. So it lost nearly 6%. So this happens as well. So if in general, I should say that if the market directional change does not last for, I should say, 2–3 days, it's going to be very difficult for the momentum algo to make money. If the trend lasts like a week, it's usually a profitable trade. And actually we had one today when we exited the momentum trade, which was entered into on, I think, Friday the 15th of July. Yeah, Friday 15th, and we exited today. So that's, of course, like a 7 trading day holding period, or 6–7 trading day holding period. In other words, like 12 calendar days, but there were 2 weekends included. And so then, of course, we made money on that trade. But if the trend changes after a day or after 2 days, it's highly unlikely that the momentum algo will make money. So then the money that could be made has to come from either the bias, which can be very short term. Sometimes it's in a trade only a day or less, or from the hedge, which can be very quick at changing directions, as we also saw recently when we had a couple of trades in 2 days. So risk management is the key thing, as I've already mentioned. And the reason is quite obvious. We can't control what the return is going to be on the market. We can only control the risk. And so that's why, although it's 2 sides of the same coin, we have to try and introduce what I call convexity. In other words, trying more and more power into a move and only adding to the positions when it's really worth it. So we usually scale in because one algo may kick in, a second algo may kick in later, and then a third algo may actually do the opposite, like the hedge is usually going to do the opposite of what the two others are doing. But then when the market is really on fire, either to the upside or to the downside, the hedge is going to pick up on that strong directional movement, and it's probably going to be aligned with the other two. So instead of having a position which could be +2 from the momentum, +2 from the bias, and -2 from the hedge, which still would leave us with a position of net +2, it will probably then change. And so the -2 from the hedge will be converted to a +2, which would build it to a 6 slot to the long side, in case the market is really very strongly to the upside. It doesn't happen very often, but at times, of course, it does. And then it's very quick at actually trying to exit. And the exits come usually from the momentum after 3-4 days. Now, today was slightly longer in the trade for 12 calendar days or 7 trading days. The bias can be quicker, as I said, and that's due to the fact that it's using a different exit methodology. So in terms of risk management, we use position sizing. So how big shall we trade or should we trade? We try to avoid extreme situations by going against the grain, so to speak. If you're long and the market is really showing the first signs of potentially changing direction, the hedge is kicking in quite quickly. And so we diversify by using different methods and also different time frames. So in terms of time frames, the hedge is actually the one which is looking at the biggest block of data. In other words, it will look at the last 5 to 10 trading days, and it's not paying too much attention to what is happening within the day or inside the day. It will look at the whole block of data. In other words, it's a bit comparable to a simple open, high, low, close methodology. So where we look at daily data, a daily candle, so to speak, and then look back, say 1 or 2 weeks, but not more than that, depending on volatility. The bias is more like an intraday time frame, and the time frame can be really tiny, from 5 minutes to something like 2-3 hours in terms of slicing up the day. And the momentum is really short term, but is quite critical in terms of determining when there is a significant move, which can be translated as a real trend. And so the momentum on the short-term basis is using something similar to like a 5-minute bar equivalent, but then spread out in time using the volatility concept. So volatility is really the driving force behind everything. Why? Because it will warn us when there is a potential extreme event being detected. So through the hedging algo, the bias, of course, needs to represent volatility in such a way that when the market is grinding up slowly but steadily, that volatility needs to be interpreted differently than when there is really a spike in terms of price movement. And momentum, of course, tries to go for the detection of trends, really directional movement. So it's different time frames, different methodologies, and that is all combined into one overall strategy. Now, as I mentioned earlier, we're using different positions, but try specifically to avoid these black swans. We use different instruments, different methods and time frames, but then key is this, what I call the allocation management. So the building of positions over the life of the trade, scaling out or scaling down, scaling in, and that's what we use most of the time. So by the scaling in and scaling out, as I said, it's about building convexity, and we do that specifically in the bias and the hedge. The momentum, as I mentioned, is the more static one of the three, and is either going long, flat, or short. It's not going to add on to the trade. It's not going to say, well, I have a long position of 2, I'm now going to add a third one or a fourth one. That's not going to happen. That doesn't work actually with the trend algo as it has been designed. It's less flexible than the two others, but both the bias and the hedge will do that and may build their position from scratch to +1, +2, even +3, and very exceptionally even +4. But remember, never exceeding the overall limits of +6 to the long side or -6 to the short side. Then profit taking is also something which is not available in the momentum algo, but does occur regularly on both the bias and the hedge. And that basically means that we will be reducing the position from the current one to a smaller one. It could be going from 3 to 2, or from 3 to 1, or from 2 to 1, or 2 to 0 is of course a total exit. But so it's usually a gradual exiting of the current position within a specific algo. And then the only one which is using what I would call trailing stops is the bias, where it will use a so-called step function. In other words, it's going to increase the stop level when we're long. In other words, diminishing or decreasing the distance between the stop exit level, the exit and the entry, or the current price, gradually over time and as a function of volatility. So it's not going to be time dependent, but it's going to be volatility dependent. It doesn't change very often. It's not going to change 7 times within the same day, for example, but it could change 2 or 3 times within the same trading day. And a different thing with regard to the bias and the momentum is also that when we are in a trade with a momentum algo, let's take an example. If you would go long, say at 39.50 around the current price level, and we would see an exit, a long exit at say 39.10, so 40 points lower, that stop, as you know, is fixed all day long. It's not going to change. The next day, if the market is around the same level, we could see the stop getting further away. It's not necessarily so that the stop distance, which initially was say 40 points or 60 points or 25 points, is going to be the same or smaller. It could actually be wider, and that's a function of what's happening in the volatility spectrum, and that's dependent on different things like the VIX structure, the term structure, and the skew, for example. So if we expect that there is a big change coming in the volatility, then we might, then the system actually will say, well, you need to put the stop further away in order to avoid trading within the noise. So that basically means that the stop level can be further the next day than the previous day. While with the bias, that's never going to happen. And of course, the hedge doesn't really have a stop. It's only going to reverse positions from long to short, from short to long. So there is no real stop. The only thing that will happen is that it will determine a level where it will switch gears, in other words. Here I think is an interesting comparison for the last 7 years and a half, between Enigma and the S&P. And this is mainly reflecting what I said earlier. If we have very strong months in the S&P, and these are the 10 strongest months of the S&P since January 2015, you see it's about 7.8% on average when we take these 10 strongest best months ever, not ever, but since 2015. During these same months, you see the performance of Enigma. So it's not necessarily so good, 12% compared to 3.7. If I take the worst, 551, so the 10th best, I should say, it's about 0. Occasionally, we could even lose money, like in October 2021. The market has a great month, and we're actually down. It's not a pleasant thing, but it does happen. And also exceptionally, which is the example we saw, in November 2020, we nearly matched the performance of the market. So, but in most cases, we will have something like 30% over these 10 months compared to 78. So it's about 35%. So less than, slightly more than 30% of the performance of the market. And the other side of the coin is, of course, when the market is really having a bad time and losing from -12.5 to -5. These are the 10 worst months of the S&P. You see on average 7.7 per month, or 77 over the 10 months. Well, over that same period, during these same months, Enigma didn't lose money, actually made money, and made something like 5.5%, 5.65 to be precise, per month on average during these same 10 months. So 56.5. And that's, of course, what brings the total performance to a positive number. If we simply add these extreme situations, the 10 best in the 10 months, well, the S&P would basically be flat and Enigma would be up something like, I should say, like 86%. Now, if you look on a more advanced, I should say, return risk statistical level, we compare returns, risks, and reward to risk ratios, then you can see that we have an average return per year of 20% with a drawdown of about 16%. And that's using daily returns of closed trades. So it's not taking into account the open trades. It's not based on NAV, it's based on closed trades for the whole period. And standard deviation is quite high, in my opinion, in relationship to the return. That's why the Sharpe ratio is barely above 1, about a 1.15 Sharpe. And in terms of Sortino ratios, and it's taking into account the downside deviation only, so not looking at the positive surprises, only the negative nasty months, I should say, deviations from the average. So then we have a Sortino ratio, which is quite high, 3.58. Then the drawdown, as I mentioned, nearly 16%, which results in a what is called a capital to risk ratio, or they call it also an MAR, a MAR risk ratio. And this is 1.29, so the return divided by the maximum drawdown. Also, performance is like 2.14, and the return adjusted for drawdown is 16.5. So we have positive months about 71% of the time, which is about 8 months out of 12 per year. The average month is 3, the average losing month about minus 1.6. And we can have some extreme months, like an extremely good month was March 2020. And a very bad one was the one we saw, which was May 21. But important from this table, I think, is the percentile distribution, where we see that it's very hard for the program to make less than 7%. Only in 5% of cases, we would end up with a return which is less than 7.3%. On the other hand, volatility or standard deviation of returns is going to be contained within about 20%. So we can't really, we don't need to be afraid, in other words, that volatility might go through the roof and we would have a standard deviation of, say, 35%. That's not going to happen easily. And then the ratio of these two, of course, is an interesting ratio, about 36%. So if we even take the exceptional weak performances, yearly weak performances, exceptionally nasty volatility environments, we still would end up with a decent return compared to the risk. Now, another important feature of the program is, of course, the comparison in terms of correlation. When we compare the performance to the S&P, we see that on a slightly short-term basis, and by slightly short-term, I mean with a look-back period of 12 months, then we see that volatility, that correlation is really not very steady. Why? Although the median is like 0.11, you see that here in the table, it can go as high as 0.71 or as low as minus 0.7. So it can be all over the place. And we see that, for example, in March of 2020, when volatility on the S&P became really excessive and the S&P, of course, tanked, then we see correlation also going down, which is a good thing, of course. So negative correlation when the market is performing badly is a good thing. The other way around, if the market is performing well, we need some positive correlation so that we also can try to track the market to the upside. And that's what's happening here in this period, for example. So overall correlation is, when you measure it over a 12-month look back, virtually inexistent, so or not significant, as I would call it statistically. And on the longer term, so with a look back of 3 years, 36 months, it's even smaller. And of course, then the excesses to the upside or the downside are even further reduced. 0.53 is the biggest positive correlation we saw, and -55, the biggest negative one. So it's obvious that it becomes a very interesting diversifier to any long equity portfolio, and it also has a very low correlation to other alternative strategies, option strategies or other. So it provides, of course, some pretty effective downside protection because it has an asymmetric return profile. And I've been trading the program since many, many years. So how does it look now? So we have different possibilities to transmit the alerts. The preferred one, of course, is Slack. And you see here, this is today. These were the signals which were sent out today. So we started, as you can see, with a position on the Thursday of +2. On the Friday, we just had this trade, and we ended the day with a net position of +1. Today, we instantly had this long exit signal in the momentum, which was filled quite quickly. And then we see that the net position, of course, went from +1 to -1. And then later on, we had this trade in the bias where we sold another one. And so we went from -1 to -2. So if you look at these numbers, so you see this Enigma trade alert has a number. In this case, the last one which was sent out was 209. So in other words, we have sent out 209 messages since we started about mid-May, and we have traded 60 times. So not every trading signal is going to lead to a trade. For example, we could have a long exit momentum, which we had since we entered into the long trade, and every day we have a new signal to exit the trade, but only today, so on the 25th of July, we exited this trade while we entered into it on the 15th, so 10 calendar days ago. So this momentum signal to exit is basically the protective level for the position we were holding, and that level will change every day, but not necessarily leading, of course, to a trade. While this one on the bias and on the hedge, we usually have a trading signal that results in a trade. Why? Because it's using in most cases a trade at market, so there is no reason to delay execution. Occasionally the hedge or the bias can have an exit feature which says try to exit or enter occasionally on a limit, and then of course it could take some time, and we could actually we have this OCO order structure that we have built in to avoid missing out on a trade, because when we started the service, I think we had 2 trades where we missed just by a hair the limit order that we entered into or that we send out. So in order to avoid these kind of situations, we will always have now a limit order in combination with a stop, so that if the market takes off either to the upside or to the downside, then we will always getting a fill. Of course, the stop will be a worse fill than the limit order, but at least we are not going to miss out on a trade. And miss out on a trade could be avoiding a situation where we miss out an entry, but we definitely also don't want to miss out an exit. And that's why on the exits, there is also going to be a stop, and occasionally in combination with the limit. But in the majority of cases, both the bias and the hedge algo will use market orders instead of limits or stops. Then on the website, of course, we have all the trades which are being classified here, and they are classified by trade number. In other words, they are not necessarily in chronological order. For example, you don't see on this short extract that I took earlier today the exit of the momentum trade. Why not? Because it's classified next to the entry date, so you will find it a bit lower next to the entry date on July 15. While, for example, this one, the long entry bias and the long exit bias We entered here on the Thursday, 21st. We exited today. And the same goes for this one, for example, where we entered on the 19th and we exited on the 22nd. So they are basically stringed together. And 59, 59, trade 59, +2, -2. Then also I provide on a daily basis a short recap, which is 3 or 4 lines of market briefing. In other words, so what happened today in the market, like this is the position that I sent out on the 22nd, last Friday. So of course we're working with this magnet level that we have been talking about before, and the market and the model basically indicated some resistance at 4008. Well, we actually went slightly beyond it, 4016, before the market reversed, and then we dropped about 70 points. And as a result of all this momentum trade stuck with its long position. We were not exited because I think on the Friday we had the stop at 3,910, and the market only dropped to like 3,925 or something. So we were the long exit position was well placed, and we exited today about 40 points higher. And buyers, on the contrary, exited one of the 2 contracts. And the hedge, as you see here, stayed with the trade. And then also on the same position sheet, you see the last trades that we did for each of the algos. So this one exited on that very same day. This one was still in the trade from the 15th and had entered at 38.28. At that point in time, it was up about 219 points. And then here we have, this is points for the whole position. So of course we need to take into account, these were 2 contracts. And this one had only 1 contract. And here we have the short 2. So these are sent out on a daily basis. And then of course, apart from that, people can send me questions. Like I show here one example. One of the subscribers asked what is really meant by short-term extreme price movement. What do we mean by searching for short-term tail risk event? What is short-term? Please define it. So then I try to give them, of course, an answer to these questions. So these kind of things are also part of the, call it Enigma service. So if people have a specific question with regard to either statistics or different features that are being mentioned in the signal service, then please feel free to send me these questions. Then also, as I've mentioned to Tom, I have opened a separate account since we started the Enigma service. So this is my IB account, which has been dedicated to only doing the exact same trades as we send out. So it started on May 16th, and this is still Friday. You see, it started with 60,000. It's now at 51,000. So it lost 89,000 at first sight, but I withdrew 11,500 here. So that's the worst performance, the best return. So the worst day that we've seen was this one on May 24th, a drop of 3.81 in the account. The best one was on June 24th, exactly a month later, of 5%, 539. And that's the return according to IB over that period from 16th of May till now, taking into account, of course, the withdrawal. And the statistics that they provide as well is, you see the drawdown, using that is 11.64% according to IB, return, and peak to valley ratio, peak to valley period is from May 15 till June 8, sharp ratio of about 8, standard deviation of 1.57. So these kind of things are also tracked, because for me it's important that I can more or less follow and see what the return is on a specific account which is trading nothing but the micro ES, because I'm trading normally the ES on relatively bigger trading size, but I'm here doing exactly the signals as I'm sending them out. And of course the fills will be slightly different than the signals that I send out, but I also course, report the fills exactly as I have them in my own account. So I think that's also useful to mention. So maybe let's have a look at the chat, if there are any questions, because I haven't been able to track the chat.
I don't see any questions, Luc.
Okay, that's fine. That's fine. It's maybe good news.
Yeah, that means it's clear.
Okay.
Sorry if my voice is a little hoarse. I ended up with COVID last week. Just kind of.
Did you?
Yeah, just kind of
Wow.
getting through just the final steps. It was more like a bad cold.
Okay.
We had 4 Pfizer shots, so maybe that helped.
Okay. Well, also here in Belgium, it's a bit similar. It's on the up move, the number of cases, but so far so good, I should say. For me personally, I haven't been yet been victim to it, so I've not yet caught it, but apparently it's less severe than it was thanks to the vaccines, of course.
Well, plus viruses tend to do that. They tend to be easier to spread but less deadly as time goes on.
Exactly. Yeah. Okay.
Oh, and by the way, Gabby is now a U.S. citizen.
I saw that. Fantastic. Really good.
But she's still a Belgium citizen. She's dual.
Okay. That's also good.
She wants to keep 1 foot on each continent. So
excellent. Okay.
Any updates on the you were talking with those guys about setting up some kind of shares or something people could buy?
Absolutely. So I had several meetings with the people from London on issuing this AMC called an actively managed certificate, and it's probably going to be launched in September. So that's what we have as a planning. Now, of course, it's holiday period in Europe, and so it's a bit tough to advance. But as soon as we have some more news, the process is going to be started. I've been told that it's going to take something like 3 weeks for the program to be issued, and then it's going to be tradable on the exchange in Frankfurt and Milan.
Okay.
So that's the plan, and it's going to be accessible with very, I should say, accessible tickets.
Like small
Probably
share
like
price.
Yeah, it's probably going to be something like 1,000 euros or dollars at most.
Okay.
And then there won't be, and if people buy bigger shares, it's or bigger tickets, I think it is from 50,000 onwards, then there won't even be any spread being added to the net asset value. Net asset value will be on a daily basis, and so then there will be no spread added to it if you want to buy or sell. While if you buy it on the exchange, either Frankfurt or Milan, it's going to be a 0.5% on the entry and 0.5 on the exit. So it's the ask price is going to be basically 0.5% above net asset value, and the same for the bid, 0.5% below.
Okay.
But I'm looking forward to that. So it's going to hopefully start in September. So
and people in the US should be able to purchase those, I assume?
I don't know that, but I suppose they can, because if they can access something, if they can access any security on the Frankfurt exchange, then it should be possible. Now, on top of that, which I think is also a good thing, we expect that people who have an IB account can buy directly on the IB account.
Yeah, IB is really good with the listing everything in the world.
Yeah, so that would make it really easy. While if people don't have an IB account or a Saxo bank account, which is the other one, which is probably going to be in the loop, then they should contact their bank or broker, and then with the ISIN code, they can of course purchase a certificate on the exchanges. But people with an IB account, it's going to be really simple, I think. Oh, I hope. Let's wait and see how it develops.
So it sounds like second half of September.
Yeah, that's probably a realistic estimate. Okay,
very good. That's good news.
Yeah, and so the performance is pretty steady. So the last couple of months, even the last 2 months, were especially the start was pretty difficult. with the hefty drawdown, as you saw here on the account. You see here, if you see the return, it dropped to like over 10%. Yeah, the exact number from IB is minus 11.64, so that was pretty big. But then it recovered pretty quickly, and now it's like steadily going up. So it's up about 4.5% here over that measurement period. So I hope to continue to see that, and that we can, of course, provide subscribers with some decent performance over, say, a period of several months.
Looking great. Lots of good updates. Really appreciate it, Luc.
My pleasure. Okay, terrific. So as there are no questions, then we could probably more or less
just end it. Yeah.
Yep.
All right. Well, thanks everyone for coming. And Luc, thanks again for presenting this updated information. I'll get this recorded, posted in the library as soon as I can, and continued success with Enigma.
Okay. Thank you, Tom. Thanks so much for your help.
All right. Thanks, everyone.
Bye-bye. Thanks.
Bye.